Hectic market. Hectic market condition is also can be interpreted as market indecisiveness. To confirm hectic market condition, we need to see rapid moves all over the place. It can be big candles, long tails, with some clear movements in it, and again some rapid movements. But why these rapid movements happening? There are quite a few reasons. First, and most common one, due to lots of economical events. Some economic news might be good, some bad. Therefore, traders not to decide for direction. In other words, fight between bulls and bears. So volatility should also spike at these times. Also could happen when traders and investors feels optimistic and enthusiastic about the asset prices, but out of the blue appears some bad news within. That could lead to hectic period as well. Another situation for hectic periods to happen, for example, when bulls dominating and prices rise, but bears enter the market quite heavily. That leads to market indecisiveness and hectic period. Another situation, companies' shares are bought and sold quite heavily at the same time, and that leads to hectic period. Speaking about volatility. At the hectic period, high volatility represents big movements on the trading chart. But it doesn't mean that in side boom period of a market mood, volatility is low and nothing is happening. Behind that could be some big players of a market, and in reality, a lot of market orders are traded, so don't be surprised when this nothing happening spikes in one way or another. Usually hectic periods don't last for a long time. Up to a week at the most, if there was intense economic period, or whatever. To identify hectic period, we need to use trading chart. Hectic periods don't appear in bigger time frames, and especially to daily. It could be some small, either up or down candles with some tails. Let's take a look at the chart. It is DAX 40 futures market at 5 minutes time frame. At market opening time, right here, spiked up, then forming some uncertainty with a range and quite powerful movements. Then spiked again, and again moving down with the same range. That is a hectic period, but not that terrible anyways. Let's switch to another market for another example. It is Nasdaq's futures market at 5 minutes time frame. Market was trending upwards. Fast trend turned into slow going trend. Market condition was good until this rapid movement appears. Might signaling downtrend. However, some movements in between, then again some spike down and up, one after another until market closes, moving sideways, and the next day again a rapid environment, until finally forms downtrend. Dirty market environment, and could cause many negative trades for new traders. How to act in hectic environment? Especially if you are a new trader, best things to do is not to trade. Your stops can be pulled quickly and easily. Really dangerous place to trade in hectic environment, even for experienced traders. Especially if you are using some kind of indicator strategy. Biggest flaw of indicators that we are late and intend to produce many negative signals. And especially at hectic environment, there is no questions about it. It doesn't mean that it's not possible to trade at this period. Of course, possible, and sometimes produces great results. If you know some area which in the past worked really well, or you identified some good looking pattern or whatever, risk and money management rules applied, you can trade. Nothing wrong with that. In any case, better psychologically be ready to accept loss. That will protect your mental health. Shortly, better do not trade in hectic period if you are new. Remember that these periods do not rely on past performances too much, and in any strategy might produce false signal. Take that into consideration and be very careful. Also, if previous day was hectic, do not expect for this day to be better. In other words, if previous day was hectic, current day will be the same unless you will see clear trading environment. Let's get to a chart to see what I mean. At this time, it is Dow Jones 30 futures market at 5 minutes time frame. As we can see at the beginning, market was in slow downtrend until huge spike happens. Hectic market environment. Hypothetically imagine that we saw this from yesterday movement. At night, market moves sideways for a bit. What we know now, that we have to be careful and hectic period might continue. What we saw next. Market moving sideways with some small uptrend seems good. Until again, these nasty movements continue throughout. Market closes, moving sideways, rapid move downwards, hectic movements in a range until finally we can see clear downtrend. Great trading environment. So there was 3 trading days. At the daily time frame, you're going to see this. First few days nothing was happening. Small movements up and bigger one downward, which is last trend down, which we saw. Bear market starts to be trendy. But in reality, these first few days were very nasty, and even the third one. Just later nice trend down appeared. What I mean by that? When market closes and moves sideways for a bit, it doesn't mean that hectic period is over. Hectic period is over when market shows you that it's over. Floating market. Floating market is the most dangerous market environment in the world of trading. Usually, that type of market condition disrespects any rules, strategies, and leads to losses. However, to identify is not that simple and easy. And before notice that market turned into floating one, you might receive few negative trades. Losses are an integral part of game. You have to accept that. You cannot avoid losses. What you can do is to minimize losses by following your strict risk and money management rules. And when floating market appears, keep your fingers away from trading screen. It might take time to get familiar with the market and get used to identify that type of market condition. Floating market is also some kind of market indecisiveness. Hectic, side move, and floating markets can be called market indecisiveness. Difference between those is clear. A hectic market produces rapid movements all over the place. Side move market identified in slightly bigger time frame and moving in a range. Floating market produces unpredictable movements in the whole chart. It means that it can appear in a range period, in a small trend, etc. Let's get to the chart and identify that type of market condition. At your screen, it is DAX 40 futures market at 5 minutes time frame. Market was falling downwards, then appears strange candle with a long tails in both directions. Why that happens? Hard to say. Anyway, after that, market continues to climb. We can predict for an upturn to come, but for that we still need to look at bigger time frame. Market produces lower lows as well as higher highs. So for my view, market is already floating and hardly predictable. Drops quite heavily and moves sideways after market closing. Next day again, strong movement downwards, followed by the same strong movement up. Consolidating in a range, again higher highs and higher lows, until spiked up, movement in a range once again, and market closes. What can happen next? Hardly to predict, since the past few days were pretty much floating. Of course, we have to look at bigger time frames to get full view of what's happening in the markets. Let's switch to other market for another example. It is Nasdaq 100 futures market at 5 minutes time frame. Another great example of floating market. After this strange movement, market moving in a range, which is night movements, and starts to be floating. As you can see, market moving in one way and another way, producing many false signals, and later on gapped above. Really bad market environment. And the best thing to do when you see something like this, to trade another market or to have a break day, because what you can expect from that environment is to receive negative trades, nothing more. Of course, sometimes happen when you open trade and market jumps to your target right away. That might be just luck, and unhealthy for your further trading career, so to speak. Last thing you need is to get emotional on some random trade. Another small hint to identify if a market is floating or not: by past support and resistance lines. For example, if you draw some support and resistance lines which worked really well in the past, meaning bouncing from that area, but lately dancing above and below that area, that could mean that market turned into floating one. However, you still need to see clear uncertainty. Last small topic to discuss is levels. Basic technical analysis levels to identify for your general expectations. For example, when market moving in a trend, either up or down, forming areas which later might turn into support or resistance. For example, if there is a downtrend, then lower lows or lower highs should be marked for later references. If later price disrespect that area, then forget about that. Only if you receive some kind of pullback, only then you can take into consideration for your further trading decisions. Let's take a look at the chart to see what I mean. At your screen, it is DAX 40 futures market at hourly time frame. Market was trending upwards until we noticed lower lows and lower highs. At this moment, we can say that market is in slow downtrend, at least in hourly time frame for sure. Let's mark these areas for our further expectations and general view. What is happening next? As you can see, market bounces one time, another, until starts floating around and level becomes irrelevant. Upper line word didn't reach, so we don't know nothing just yet. But if we were marked next lower high, we notice that we receive another confirmation right into the point. You see how much we can predict in this simple way. So when you combine quite a few tools, combination of charts and other technical analysis techniques, trading starts to make sense. In conclusion, there are 4 types of market moods: side move and trendy, fit and good for trading, hectic environment is dangerous to trade, but you still can make trading decisions if you know what you're doing, and floating market. Big red flag for trading, unless you like to throw your capital away. To identify market mood is essential for trading, and every trader should do that before start trading. In this way, you know what to expect and what you can take from market at any given day or week. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.